Good morning, friends. Today we can discuss about payback period method. We will discuss some of the problems which will help you to understand how you can calculate the payback period. So first of all, we can have an introduction to the topic payback period. Payback period is also known as payoff period, payout period, or replacement period. So payback period is the length of time, or it is the length of the period required to recover the initial cost or initial investment of the project. Imagine that you are going to start a hotel business and you are investing rupees 5 lakh for that. So definitely we will expect some income from the hotel business, right? So the time taken to recover the initial investment made, that is the 5 lakh rupees. So the time taken to recover this 5 lakh rupees is the payback period of this particular business. So we can say that it is the expected number of years during which the initial investment or the original investment is recovered. So if we are comparing two projects with different payback period, definitely the project with the shorter payback period will be the better one. Normally, you will be asked to calculate the payback period in two situations. The first one is when the annual cash inflow from the project is equal. And the second situation is when the annual cash inflows are unequal. We can see these two situations, and the approach to calculate the payback period in these two situations is different. We can see it. So first of all, we can discuss the calculation of the payback period when the annual cash inflow from the project is equal. So the formula to calculate payback period when cash inflows are equal is the original cost or the initial investment of the project, denoted by I, divided by annual net cash inflow or the net earnings, which is denoted by C. So once again, remember the formula: payback period is equal to the original cost of the project divided by annual net cash inflow. Now we can discuss a particular problem. The Delta company is planning to purchase a machine X. Machine X would cost rupees 25,000 and would have a useful life of 10 years. The expected annual cash inflow of the machine is 10,000. You are required to compute the payback period of machine X. And the second part, conclude whether or not the machine would be purchased if the maximum desired payback period of Delta company is 3 years. So there is two parts in this question. With this given information, you need to calculate the payback period, and you also want to give your opinion whether this Delta company should purchase this machine or not. So the Delta company will purchase if the payback period of the machine is equal to or less than 3 years. If it is greater than 3 years, the company is not willing to buy this machine. So going to the solution part, since the cash inflows are equal, we will stick on to the first formula, that is the original cost of the project divided by the annual net cash inflow. Now we can write down the given information from the question. The original cost is given, that is 25,000. The annual net cash inflow is also given in the question, that is 10,000. So the information which is required to calculate the payback period is given in the question. The original cost is given 25,000. The annual net cash inflow is also given. So the payback period is just 25,000 divided by 10,000, you will get 2.5 years. So in the question it is said that what will be the decision? According to the payback period analysis, the purchase of machine X is desirable because its payback period is 2.5 years. which is shorter than the maximum payback period of the company, that is 3 years. So if the payback period lies below this 3 years, definitely the Delta company will like to purchase this particular machine. So it is below 3 years, that is 2.5 years. So definitely the company can buy it. Now we can move on to another question. See this particular question. The management of health supplement wants to reduce its labor cost by installing a new machine. Two types of machines are available in the market, machine X and machine Y. Machine X would cost 18,000, machine Y would cost 15,000. Both the machine will produce an inflow of rupees 3,000. Which is the best machine to purchase according to payback method? So this health supplement, this company or the management has got two options. Definitely they need to install a new machine. For that they have got two options. Either they can buy machine X or machine Y. Machine X costing 18,000, machine Y cost 15,000, and both the machine will give you an inflow of 3,000. You are required to calculate the payback period method. Okay. So we can see that in the case of machine X and the case of machine Y, they will produce an inflow of 3,000. So the inflow is equal. So we will stick on to the formula, original cost of the project divided by annual net inflow. So first of all, we can calculate the payback period of machine X. We can write down the information given in the question regarding machine X. That is, cost of machine X is given 18,000, annual inflow of machine X is also given, that is 3,000. So now we can calculate the payback period of machine X, which is equal to 18,000 divided by 3,000, that is 6 years. 18,000 is the original cost, 3,000 is the net cash inflow. Now we can calculate the payback period of machine Y. We can write down the information which is given in the question, that is, cost of machine Y is 15,000. There is a small correction here. Annual inflow of machine Y is 3,000. So now we are going to calculate the payback period of machine Y. It's not X. This is the payback period of machine Y is equal to 15,000 divided by 3,000 is 5 years. So from this information it is clear that the payback period of machine Y is 5 years and the payback period of machine X is 6 years. So shorter the payback period, better the project. That means the project or the machine with shorter payback period is machine Y, so hence this will be the better one. So we can give a suggestion that according to the payback period, machine Y is more desirable than machine X because it has got the shorter payback period than machine X. So like this we can compare two projects. Hope that part is clear to you. Now we can move on to the next part, the next situation where you may be asked to calculate the payback period, that is the calculation of payback period when the annual cash inflows are unequal. Here the formula to calculate the payback period is little bit different, that is E plus P divided by C when the cash inflows are unequal. Let's see what E, B and C are. E is the year preceding the final year of recovery. B is the balance amount to be recovered. C is the cash inflow in the final year of recovery. There's a small note here. When the cash inflows are unequal, we need to cumulate the cash inflow. That's the important part. When the cash inflows are unequal, then the payback formula is this one, and we need to cumulate the given cash inflows. Keep those two things in your mind. Now we can see a particular question. An investment of rupees 2 lakh is expected to generate the following cash inflow in 6 years. On the first year 70,000, second year 60,000, third year 55,000, fourth year 40,000, fifth year 30,000 and sixth year 25,000. We can see in each year the cash inflow are different, unequal. Okay, You are required to compute the payback period. Should the investment be made if the management wants to recover the initial investment in 3 years or less? We need to give our opinion regarding that. So here one thing is sure, the payback period formula is E plus B divided by C because cash inflows are unequal. And since the cash inflows are unequal, we need to cumulate the cash inflow. So let's see. Because the cash inflows are unequal, the payback period formula cannot be used to compute the payback period. That means the initial investment divided by net annual cash inflow. That formula is not applicable. We can compute the payback period by computing the cumulative net cash flow. So we should draw a table for the cumulative cash inflows. On the first year, cash inflow is 70,000. Cumulative inflow is 70,000. Second year 60,000, so the cumulative will be 1,30,000. 70,000 plus 60,000, 1,30,000. And the third year 1,30,000 plus 55,000, 1,85,000. On the fourth year 1,85,000 plus 40,000, you will get 2,25,000. On the fifth year you will get 2,25,000 plus 3,000, you will get 2,55,000. On the sixth year 2,55,000 plus 25,000, you will get 2,80,000. So purposely I have given this a green and red color. Let's see. The initial investment is 2 lakh rupees. So we need to find out the payback period. That means we need to find out the time taken to recoup or recover this 2 lakh rupees. So while looking on to this cumulative cash inflow, 70,000 is recovered in first year, in the second year 1,30,000, in the third year 1,85,000. We need to recover 2 lakh, right? On the fourth year it is 2,25,000. So it is clear that this 2 lakh is recovered only on the fourth year. On the third year it is 1,85,000. On the fourth year it is 2,25,000. So 4 years completely is not needed to get or recover 2 lakh rupees. So we can say that this is the year of final recovery, fourth year. Because 3 years is not sufficient and 4 years is not needed to get this 2 lakh rupees. That means this fourth year is the final year of recovery. So we can write the final year of recovery is the fourth year. So E, we know the payback period formula, E plus B divided by C. E is the preceding year of the final year of recovery. So the final year of recovery is fourth year, so the preceding year is 3. So E is 3. Now B is the balance amount that should be recovered. We know that the amount that should be recovered is 2 lakh. On the third year, 1,85,000 is recovered. So the balance amount to be recovered, B, is 2 lakh minus 1,85,000, that is equal to 15,000. And C is the cash inflow in the final year of recovery. The final year of recovery is fourth year and the cash inflow is 40,000. So C is 40,000. So now we have got all the information for the calculation of payback period. Payback period is equal to E plus B divided by C. That means 3, this is the formula, payback period, E plus B divided by C, which is equal to 3 plus B is 15,000, C is 40,000. 3 plus 15,000 divided by 40,000 is equal to 3.375 years. In the question, it is already said that this particular company is interested in the investment only if the payback period is equal to or less than 3 years. So here the payback period is more than 3 years, right? So the payback period for this project is 3.375 years, which is longer than the maximum desired payback period of the management, that is 3 years. So this investment in the project is therefore not desirable. So that's how we can calculate the payback period when the cash inflows are unequal. You need to remember 2 things. First of all, the formula is payback period is equal to E plus B divided by C. when the cash inflows are unequal, and when the cash inflows are unequal, you need to cumulate it. Now we can discuss another problem, that is Apple Limited has two project options, Project A and Project B. The initial investment in both the project is rupees 10 lakh rupees. Project A has even inflow, rupees 1 lakh every year. Project B has uneven cash inflows as follow: on the first year 2 lakh rupees, on the second year 3 lakh rupees, on the third year 7 lakh rupees, on the fourth year 1 lakh 50,000. Now let us apply the payback period method to find out which project will be the better. So this is a question that will lead you to the calculation of payback period in two situations. In the case of project A, you need to compare project A and project B. Both the project cost is 10 lakh rupees. And the project A has the cash inflows are equal. That means every year 1 lakh rupees is the cash inflow. So that means you need to focus on the first formula for the calculation of payback period. No need to cumulate the cash inflow because the cash inflow in all the year is equal for project A. But in the case of project B, the cash inflows is different. So you need to cumulate the cash inflow. So first of all, we can calculate the payback period of project A with equal cash inflow. So in this question, we have both cases. The calculation of payback period of project A having equal cash inflow and the calculation of payback period of project B having unequal cash inflow. So we need to cumulate it. So first of all, we can find out the calculation of payback period of project A. Since the annual cash inflow are equal, we need to stick on to the first formula, that is original cost of the project by net cash inflow. So all these informations are given. Cost of project is given 10 lakh rupees. Annual cash inflow is also given 1 lakh rupees. So both the information is given. Payback period of project is 10 lakh divided by 1 lakh is equal to 10 years. So the calculation of payback period of project A is completed. Now we need to calculate the calculation of payback period of project B. Since the cash inflows are unequal, we need to cumulate the cash inflows. On the first year it is 2 lakh, 3 lakh, 7 lakh, 1 lakh 50,000. So we need to cumulate it. 2 lakh plus 3 lakh, 5 lakh plus 7 lakh, 1 lakh 12 lakh plus 1 lakh 50,000 is equal to 13 lakh 50,000. We know the initial investment. The initial investment is 10 lakh rupees. So we need to find out the payback period. We need to find out what time is required to recoup this 10 lakh rupees. So in the first year it is 2 lakh, in the second year it is 5 lakh, in the third year it is 12 lakh. So it is clear that 2 years is not sufficient and 3 years is not needed to get back this 10 lakh rupees. So we concluded that the third year is the final year of recovery. So E means the preceding year. That means preceding year of third year is 2. So E is equal to 2. So B is the balance amount to be recovered. So in the second year it is 5 lakh rupees. The balance amount to be recovered is 10 lakh minus this 5 lakh. We will get 5 lakh rupees. And C is the cash inflow in the final year of recovery. 3 is the final year of recovery and the cash inflow is 70,000. So C is equal to 70,000. Now it's very easy to calculate the payback period. That is, payback period is equal to E plus B divided by C. E is 2 and B is 5 lakh divided by 7 lakh. It is 2.71 years. So now we have calculated both the projects payback period. The project A's payback period is what? The project A's payback period is 10 years and the project B's payback period is 2.71 years. Therefore, between project A and B, we can conclude that project B will be selected because it's having smaller payback period. So that's all about the calculation of this particular payback period. Now we can see, so far we have discussed the different ways or the different situation in which payback period can be calculated. Now we are going to discuss some important formulas, that is payback reciprocal formula, post payback profitability, post payback profitability index. So the payback reciprocal formula is 1 divided by payback period into 100. Post payback profitability is total cash flow in life minus initial cost of the project. Post payback profitability index is equal to post payback profit divided by investment into 100. Now let's see a problem. From the given information, calculate payback period, payback reciprocal, post payback profitability, post payback profitability index. This is the given information. Initial investment is 5 lakh, annual income is 1 lakh, life of the project is 10 years. So the annual income is 1 lakh. So it is the cash inflows are equal. So the payback period can be calculated simply by dividing the original investment divided by this net annual income, that is 5 lakh by 1 lakh, we will get 5 years. That's the payback period. So payback reciprocal is 1 divided by payback period into 100. So 1 divided by this 5 years into 100, you will get 20%. Post payback profitability is total cash inflow in life minus initial cost. Total cash inflow in life is, it's already said that the net annual income is 1 lakh, 10 years is the life. So 1 lakh into 10, 10 lakh is the total cash inflow in life. Initial cost is given in the problem, that is 5 lakh. So post payback profitability is equal to 10 lakh minus 5 lakh is equal to 5 lakh. Post payback profitability index is equal to post payback profit divided by investment into 100. The post payback profit is calculated, that is 5 lakh divided by investment is 5 lakh, or initial investment is 5 lakh. So 5 lakh divided by 5 lakh into 100 is equal to 100% is the post payback profitability index. So that's all about this payback period and payback period calculations. Thank you.